Netflix just reported $12.6 billion of quarterly revenue, and then investors punished the stock anyway. The reason is revealing. Netflix is no longer being judged only on how many people pay for streaming. Netflix is trying to turn one subscription into three revenue engines: monthly membership fees, advertising, and a deeper entertainment ecosystem. Netflix says its advertising revenue could reach roughly $3 billion in 2026. But Netflix is also slowing its top-line growth, spending billions on content, and moving away from reporting membership counts every quarter. So this is the Netflix business model explained: how Netflix makes money today, why the old growth formula is changing, and what Netflix is really selling. Netflix looks simple from the outside. You pay Netflix every month, Netflix gives you a library of shows and films, and Netflix tries to keep you paying next month. But Netflix's 2025 Form 10-K shows a much more deliberate machine. Netflix generated $45.2 billion of revenue in 2025, up 16% from 2024. Netflix generated $13.3 billion of operating income and $11.0 billion of net income. Netflix's operating margin reached 29.5%. That is not a low-margin content hobby. Netflix is a scaled subscription business with recurring revenue and a powerful distribution system. The catch is that Netflix has to pay for the entertainment before Netflix can monetize the attention. Netflix had $24.0 billion of total content obligations at the end of 2025. About $11.5 billion of those obligations were due within 1 year. Netflix's business is therefore a timing game. Spend on content, attract attention, convert attention into memberships and ad impressions, then spread the cost of that content across a global audience. Netflix's first engine is the membership fee. Netflix says it primarily earns revenue from monthly fees for streaming services. Netflix bills members in advance, then recognizes that revenue ratably over each monthly membership period. That creates a predictable cash collection cycle. Netflix gets paid before Netflix delivers a full month of viewing. Netflix offers multiple plans with different prices and features. In the 2025 filing, Netflix said monthly plan prices range from the equivalent of $1 to $37 depending on country and plan. Netflix also charged extra member subaccount fees ranging from the equivalent of $2 to $9. The second engine is pricing. Netflix can raise the value of the same library without delivering a separate physical product. When Netflix improves its content slate, Netflix can test a higher price, change plan features, or steer viewers toward a different tier. The third engine is advertising. Netflix's ad-supported plan lets Netflix monetize the same viewing session twice, first through a membership fee, then through ads shown during the viewing experience. Netflix's 2025 filing says advertising revenue was still not a material component of total revenue. But Netflix's second quarter 2026 shareholder letter says Netflix expects advertising revenue to roughly double to approximately $3 billion in 2026.
That is why the ad business matters, even before it becomes the biggest line on Netflix's income statement. It gives Netflix another way to monetize viewers who are price-sensitive, and it gives Netflix a second buyer for the attention Netflix already paid to acquire. Netflix's model works because Netflix can distribute one expensive piece of content across a global audience. Netflix's 2025 streaming revenue was $45.2 billion. Netflix generated $19.9 billion in the United States and Canada, $14.5 billion in Europe, the Middle East, and Africa, $5.4 billion in Latin America, and $5.4 billion in Asia Pacific. That geographic spread matters. A show funded for one market can still create viewing, memberships, and ad inventory across Netflix's entire footprint. Netflix's scale also creates operating leverage. Revenue grew 16% in 2025, while operating income grew 28%. Netflix's operating margin expanded from 26.7% in 2024 to 29.5% in 2025. But Netflix's next phase comes with a trade-off. Netflix is shifting the scoreboard. During 2025, Netflix discontinued regular reporting of membership numbers and average revenue per membership. Netflix said it would focus instead on revenue and operating margin as the primary measures of performance. Netflix still talks about engagement. In the first half of 2026, Netflix said members watched more than 97 billion hours of content, up 2% year-over-year. But Netflix plans to publish its detailed engagement report once a year, starting in 2027, rather than alongside every relevant earnings update. That move tells you what Netflix wants investors to focus on, not just how many people watch, but how efficiently Netflix converts viewing into revenue and profit. Here is the Netflix scoreboard. 2025 revenue, $45.2 billion. 2025 operating income, $13.3 billion. 2025 net income, $11.0 billion. 2025 operating margin, 29.5%. 2025 content obligations, $24.0 billion. 2025 streaming revenue from the United States and Canada, $19.9 billion. 2025 streaming revenue from Europe, the Middle East, and Africa, $14.5 billion. 2025 streaming revenue from Latin America, $5.4 billion. 2025 streaming revenue from Asia Pacific, $5.4 billion. Second quarter 2026 revenue, $12.6 billion. Second quarter 2026 operating income, $4.2 billion. Netflix's 2026 advertising revenue target, approximately $3 billion. Netflix's second quarter 2026 revenue grew 13% year-over-year, while operating margin was 33.4%. Netflix said the quarter was driven primarily by membership growth, pricing, and increased advertising revenue. The surprising part is not that Netflix has an ad business. The surprising part is that Netflix is building a second monetization layer on top of a business that already generated more than $10 billion in annual net income. Netflix's real product is not a show. Netflix's real product is a recurring relationship with a viewer's attention.
The subscription fee is the first payment. The content library is the reason to stay. Pricing is the lever that expands revenue from that relationship. Advertising is the extra layer that lets Netflix sell the same attention again. That explains why Netflix can look like a media company, a software subscription, and an advertising platform at the same time. It also explains the risk. Netflix must keep producing or licensing content that earns attention while carrying $24 billion of content obligations. If engagement slows, Netflix has fewer opportunities to justify price increases and fewer impressions to sell to advertisers. Netflix is not abandoning subscriptions. Netflix is making subscriptions more valuable by stacking monetization on top of the same global audience. If you want more business model breakdowns built from real filings and earnings numbers, subscribe to Capital Breakdown. And comment, which part of Netflix's model matters most? Memberships, pricing, content, or the ad business?